So I'm starting the quick revision of index 111 in 3, 2, 1 and go. First of all, the number index 111. Name is joint arrangements. Now first we define what is joint arrangement. So here there are two or more parties. Here there should be joint control. What is the meaning of joint control? How many ever parties are involved, they all should have unanimous decision making. And third is there should be a contractual agreement. So we understood what is unanimous decision making. That means if we want to pass a resolution, all parties should agree. That is unanimous decision making. So let's say for example, in a contract, to approve anything it requires 85% approval. So here all have to agree to achieve this. So there is unanimous decision making. If there is unanimous decision making, joint arrangement. Same in the second case, same in the third case. But in the fourth case, if you see, they want to achieve 70%. Any three parties can achieve 70%. Okay, so there is no unanimous decision making here. There is no joint arrangement here. But there is an exception to unanimous decision making. Sometimes there are four parties. Okay, any three parties can achieve the percentage of agreement. But if it is defined that you have to agree this much percentage, and out of these four, these three parties should agree. If the combination of parties who should achieve the 75% has been defined, then in this case it will be a joint arrangement, but not between four parties, but only between the three parties A, B and D. Because here 75% can be achieved by only three parties, and who are those three parties has been defined. So it is a joint arrangement. Okay, but only between A, B and D. We understood what is joint arrangement. If it is a joint arrangement, we can have two types of joint arrangements. One is joint operation, one is joint venture. Okay, in joint operation we have three definitions. First, if the arrangement is not structured through a separate legal entity, for example, if you are coming together only contractually and not forming a new company, it is operation. Second, if you are coming together and forming a new company, but the rights in the new company can be identified individually. Okay, so each parties have rights and obligation to individual asset and liabilities. So let's say you form a new company, and in that new company you have asset liabilities, but each of that asset liability can be identified. This belongs to party number 1, this belongs to party number 2, this belongs to both the parties. If this is possible, again operation. But what if the parties have net assets, right, in the net assets? So if you are forming a separate entity and the parties don't have rights individually, but they have right in the net assets, then it will not be operation, it will be a venture. Do remember this. Okay, so in venture we have this definition: structured through a separate entity and parties have rights in the net assets. Simple. Okay, now the third definition of operation is if it is structured through a separate entity and that output of whole entity is only for the consumption of the parties of arrangement. Okay, so let's say for example, remember we are building a common pipeline. This common pipeline is only for the usage of these two parties of arrangement and not for any third party. So it is a operation. So it is a joint operation. Okay, now I had done some extra discussion also on this. Suppose if this separate entity allows the common asset to be used by third party, then it won't be operation, it will be a venture. Next point, if this separate entity does not allow the use of third party, so it is only transferring the output to the two parties of arrangement. Now these parties, when they receive the output, they themselves are selling it to third party. See, once the party receives the output, they can do anything with it. It won't stop it from being an operation. It is still an operation. But the separate entity on its own should not be able to sell to third party. Okay, do remember this. So parties, once they receive the output, they can do anything with it. But of course, this arrangement cannot sell to the third party. Okay, so in the second instance, it will still be operation. To understand this better, we did one question also. Remember this question, question number 2. Okay, this is a LDR question. I would please request you to go through this question. The example which I just gave are a part of these questions only. Okay, so a very good question. Anyways, so this was till the definition of RF. So one more thing, for it to be called a operation or venture, first it should be a joint arrangement. If it meets the definition of arrangement, then only it can either be operation or it can either be a venture. Okay, and the last thing is accounting. So if you classify it as an operation, what will the parties do? The parties won't prepare CFS. They will record their own share of assets, their own share of liabilities, their own share of income, their own share of expense in their SFS only. That is known as proportionate consolidation. Why proportionate? Because you are recording only your own share of asset, liability, income, expense. But what if it is a joint venture? If it is a joint venture, the accounting part is not covered in 111. In joint venture, SFS, CFS both becomes applicable. For SFS, you will show investment in venture as per Ind AS 27 at cost or fair value. And in CFS, you will follow equity method. That we will discuss in Ind AS 28 only. Okay, so it is just like once you get 18 plus, you are eligible to get married. So either you can do arranged marriage. If you do arranged marriage, you can stay within the house. If you do love marriage, you have to leave the house. So leave. So one thing, just last I want to clarify this. Operation has been defined in 111. Accounting has also been given in Ind AS 111. Venture has been defined in Ind AS 111, but the accounting part is not given in 111. The accounting part is given in 27 and 28. Clear? Okay. We have two more points conceptually after this accounting part, but that 2 points we will cover directly in illustration 23 and 24. So this completes the conceptual discussion of Ind AS 111. Okay. Chalo. How about a good quick recap on the questions? Okay. Chalo. I'm starting the revision of questions also. Okay. Let's start the revision of questions in 3, 2, 1 and go. So first of all, we have discussed the in the previous part we discussed about the concepts of joint arrangement. Okay. Now, apart from the basic theory questions which we have done in the concepts directly, focusing more on the practical questions here. Okay. So if you see, there is illustration number 21. Okay, it is a good question to teach how the accounting for joint operation happens. So in this case, it was mentioned that we have formed a new company PQ. Okay, where there are two parties P and Q. Both own 50% capital, but here rights of individual asset liabilities are given. Let's say it is given. If you read this, it will be mentioned that machinery belongs to P, cash belongs to both, other loan belongs to both, bank loan belongs to P, capital belongs to both. So individually they have given. So now you have to record what will P record in its financial statements. So remember, it is a joint operation as per second definition. Separate legal entity and identify the individual rights in asset liabilities. Okay. So joint operation follow proportional consolidation. So P will basically record in its own financials whatever belongs only to P Limited. Let's say machine belongs 100% to P. So full 250 will be recorded by P. Cash belongs to P only up to the extent of 50%. So out of this 25,000 will be recorded by P. Similarly, capital belongs to the extent of 50%. Out of 1,50,000, 75,000 will be recorded by P. Bank loan belongs only to P. Record full. Like the same. Okay. So same was illustration number 22 also. Same. Exactly same. They have given the bifurcation. Just allot what belongs to you. Okay. So basic question on proportional consolidation is there. Okay. Apart from this, we have illustration number 25 as well. Okay. In 25, what is given? They had mentioned that there are two companies, Alpha Gamma. They want to commence a joint construction of the property. It is very much similar to, remember that two petrol pumps are coming together and building a common pipeline. So it was a joint operation. Okay, they've clarified also. For this purpose, an agreement is entered into that provides for joint operation, ownership of the property. Okay, so and the share is equal. So whatever asset, liability, income, expenses that they will share equally. Okay, anyways, then they have said that we started the construction on 1st April. It got ready on 30th September. So if there is any borrowing cost, we are assuming it is a qualifying period and 6 months interest will capitalize from April to September. Anyways, utilization started on 1st Jan. Still, the depreciation will not start from 1st Jan. Depreciation will start from 30th September only. Anyways, life is 20 years. Okay. Cost is 40 CR. Okay. And it is said it is funded by a loan of 10 CR. So basically, if there is a loan involved, the simple thing to do is you will have to capitalize 6 months interest because 6 months construction went on. And the balance 6 months for the year, you will transfer the interest to profit and loss. Simple. Okay. And also there is one more expense, 4 lakhs maintenance. It is a expenditure, transfer it to profit and loss. The company has recorded the entire amount paid as an investment in joint venture. So accounting followed by company is inappropriate. We have to first suggest and then give the suitable accounting treatment as well. How will you suggest? So first, whenever there is this type of question, you have to write the concept first. So we will define what is joint arrangement. Then we will define what is operation and venture. Then we will say it is operation in this case. So accounting will be done as per proportion consolidation. Now in whose company's book they have asked, it is not mentioned. So I will just say whatever items are there. Because joint operation has two parties, both the parties will record up to their own share. For example, there was a PP. Cost was 40. At the borrowing cost of 6 months, you get 40.5. This will be bifurcated between the two parties alpha gamma. But this is the cost on 30th September. Deduct the 6 months depreciation, you will get the year-end cost. So this depreciation will also be bifurcated between alpha and gamma 50-50. Then what about the remaining 6 months interest? See, 6 months interest you capitalized. What about remaining 6 months? This interest you will transfer to profit and loss. Again, individually bifurcate between alpha and gamma 50-50. Maintenance cost, again bifurcate. Okay, so in exam, if you want to present this, just present the above in the statement format. That's it. Okay, so this was a good question. Then apart from this, there is one theory question number 1, just read, not very important. Okay, question number 2, I guess it is based more on the definition aspect, which we already discussed while revising the concepts. Okay, which I told you that you have to read this. This is important, but okay, chalo. Now apart from this, there are 2 more illustrations. Remember, I told you that for certain concept we will not read, we will directly do the questions. Okay, so what is there? Please have a look here. So basically, in the first case, there is one party A, and A is selling something to the joint operation. Okay, A has 60% stake in the operation, and other party of the operation has 40% stake. So if I look at the OFU here, OFU means only for understanding, you will understand that before the sale, 100% asset was with A. After the sale, the asset comes in the books of joint operation. And because joint operation has 2 parties, A and other party, as soon as it comes in joint operation, it will automatically get recorded in the books of A Limited to the extent of 60%. Why? Because A will follow proportionate consolidation. In that, whatever is there in joint operation, A will record 60% of it. So basically, before the sale, A had 100%. After the sale, A automatically recorded 60%. So effectively, A has sold only 40% of the asset, because after selling 100%, A is re-recording 60%. So the effective sale is 40%. So whenever the amount of sale is given, just record the sale to the extent of 40% only. So it is given that it was carrying amount was 100, selling price was 80. So we will record only 40% of it. So carrying amount 40% of it, sales price 40% of it, balance is the loss. You will record it in the books of A Limited, of course. Same is illustration number 24. The only difference is here A is purchasing from joint operation. So if you see closely, before the purchase, asset was with joint operation, 100% of it. And if 100% was with joint operation, A would have recorded 60% already. Now after the purchase, A gets 100% of the asset. So before purchase, A already had 60%. Now A has 100%. So the effective purchase is 40% only. So when A records, A will record not the whole purchase, but only the 40% of it. So A purchased it for 80. Okay. So whatever is the purchase price you have paid, it becomes your cost. So recorded cost. Remember, there will be no gain loss arising on purchase. Huh? Gain loss arises on sale, not on purchase. So you have paid 80. So 80 into 40%. 32 is the cost of your asset. Same is the amount of cash back. Okay. So if you want a summary of illustration 23 and 24, what is the summary? Whenever a sale purchase happens between a party and an operation, we will record the sale purchase only to the extent of other parties' share. For example, in joint operation, A's share was 60%. Still, for purchase and sale, we recorded only 40% of it. So whenever there is a sale purchase between party and the operation, record the sale purchase only to the extent of other parties' share. Okay. So this completes the question part as well. Of course, there are many small concept questions also, if you see above, but those questions, just give it a read once, because those are direct questions which get covered when you cover the concepts. But anyways, if you have time, you should of course read all the questions. My main motive is in the revision is to take up those questions which cover more of your concept from exam point of view. Okay, so I hope this was helpful. On that note, we will wrap up this index as well. A small index, a cute index you can say, but if it comes, it is scoring, because it is not as big as CFS or business combination, and not as difficult also. It is very simple. In revision, it will hardly take, you can say, 15 minutes, not more than that. Okay, so a worthy index, if it comes in exams, you can definitely score in it. Okay, on that note, let's wrap up the session. I hope this was helpful for you. Thank you so much. I will end this session here. Okay.